Welcome to the 2014 CFA Institute Research Challenge Local Final, co-hosted by the CFA Society Ottawa and CFA Society Toronto. I would also like to thank Scotiabank for being our venue and local research challenge sponsor and for allowing us to use this very beautiful space. I'd like to give a big thank you to Loblaw Companies Limited, this year's subject company.
Nice to meet you. Aria.
Thank you.
Jakub.
Joyce.
Hi. Nice to meet you. Aria.
Thank you.
I'm Aria. Nice to meet you. Nice to meet you.
Good afternoon and welcome. My name is Robert Kaptyn, along with my colleagues Raghav, Joyce, Jakub, and Aria. I'm going to walk you through a quick introduction, followed by competitive analysis from Raghav, a financial analysis from Joyce, our valuation with Jakub, and finally, Aria will conclude with the key risks to our valuation. We initiate coverage on Loblaws with a $45 price target and a hold recommendation. Loblaw operates under 4 key segments: grocery, pharmacy, financial services, as well as the recently spun off real estate investment trust, Choice REIT. They currently own 83% of Choice REIT and will use it in much the same way that Sobeys has used Crombie REIT as a source of long-term liquidity. Now, there are 3 main highlights to our recommendation: margin compression, the completion of the IT upgrade cycle, as well as the proposed Shoppers acquisition. Under our base case scenario, the Shoppers acquisition adds $2.24 per share. The Shoppers acquisition will give Loblaw an instant urban footprint, as well as turn Loblaw into Canada's largest pharmacy retailer. In order to assess the likelihood of approval, we looked at the Canadian Competition Bureau's safe harbor thresholds: a combined market share of less than 35% and a CR4, firm concentration ratio, of less than 65%. On the grocery segment, we did not breach any of these thresholds. However, on the pharmacy side, we calculated a CR4 ratio of 66.8%. While this is higher than the threshold, it's important to understand that this is a safe harbor threshold, the level where they may not have considered challenging the acquisition to begin with. Because of these reasons, we think it's highly likely that the acquisition goes through. I would now like to pass it to Raghav.
Thank you, Rob. The Bank of Canada has lowered expectations for growth and inflation, leading to lower interest rates and devaluation of the currency. The weakened dollar is lowering the disposable income of consumers, as well as making imports more expensive. The higher import prices are putting a significant strain on Loblaw's margins. According to our Porter's 5 forces, the industry is classified by high barriers to entry, leading to intense competition amongst the few established players. Margins are being cut and competition further intensified by the aggressive expansion of American retailers, Walmart, Target, and Costco, into the market. Our analyst on-site visits reaffirmed our 5 forces analysis, observing that, like Loblaw's, competitors also follow 2 strategies with respect to their stores: one, catering to a high-quality experience, and another, to lower-end products and prices. Strong corporate governance mechanisms and able management emerge as effective organic growth drivers for Loblaws. Also, a multi-year program called Flow Supply Chain is focused on enhancing efficiencies in the supply chain by improving IT infrastructure. Having the highest market share amongst its peers, Loblaw does have certain facets of strength going forward. Its private label and loyalty programs offer unique competitive advantages, with brands such as T&T and President's Choice aiding strong organic growth through increased diversification. With the impending acquisition of Shoppers, it is important to note that margins may take a hit due to generic drug reforms that have been introduced by the provincial governments. Previously, the governments reimbursed up to 50% of the branded drug equivalent, but this has now been capped at 18%. I will now pass on to Joyce, who will discuss the financial analysis.
Thank you, Raghav. Comparing Loblaw to its competitors, we know that the company has strong management efficiency. It has strong bargaining power to delay payment to suppliers. It is also able to sell inventories and collect cash quickly. However, on the other hand, we do know that the company sits at the lower end in terms of generating return on equity. Its profitability has been consistently below industry average. Hence, we further conducted a DuPont analysis. As shown in the graph, the return on equity has been mainly driven by financial leverage and the net margin, and further, the net margin has been mainly driven by the operating margin. Hence, we further believe that our negative outlook on cost of goods sold and IT expenses will have a significant impact on Loblaw's stock price. Loblaw has exhibited steady organic growth through new store additions over the past 5 years. However, looking to the future, the company faces a challenge to maintain its same-store sales growth rate as under the more intense than ever competition. As for Shoppers, it is still in the growth stage with 5% CAGR in retail square foot growth. However, same as Loblaw, we do observe that the company has a significant decline in its same-store sales growth rate due to more stores are clustered and competing with each other. Looking to the future, Loblaw expected significant synergies from intangible assets, such as control banners and private labels, which are all very hard to accurately estimate. Also, its leverage will be lower after acquiring Shoppers' assets, allowing for more borrowings and larger scale expansion plans. On the other hand, the company will have a higher operating leverage, meaning that the company becomes riskier and more volatile in both the up and downside. Overall, we expect a mixed influence of Shoppers on Loblaw. And next, Jakub will be talking about valuations.
Thank you, Joyce. We used a range of values to come up with the target price using a number of different valuation methods. A range of values include a best case and worst case scenario, as well as a switch in the model that would value Loblaw not only as a standalone entity, but also as a combined entity with Shoppers. Because Loblaw is a stable and predictable business in a mature industry, we gave the heaviest weightings to a DCF analysis and a method of comparables. A method of comparables compared Loblaw to North American and Canadian peer leaders using 4 key metrics. Among them, EBITDA, EBITDA sales, and EBITDA free cash flow allow for comparison of companies with different capital structures. And PE is a widely used metric that reflects market expectations. We took the average of all 4 metrics, and then took the average of 2 peer groups to get a price of 36.52. It should be noted, when we included companies with exposure to American markets, valuations tend to be higher. For a DCF analysis, we use a free cash flow to firm approach. WACC was estimated as a standalone entity for Loblaw as well as a combined entity, and our terminal multiple was based on historical analysis of the industry. Loblaw as a combined entity got a fair price of $47.48. As a standalone entity, the price was only $39.62. If you look at the graph in the top right, you can see that the Shoppers deal is accretive to our valuation on a best base and even worst case scenario. We then wanted to test some of the key variables and their effect on intrinsic value, so we performed the Monte-Carlo simulation. A Monte-Carlo simulation was performed on 4 key variables: WACC revenue, EBITDA multiple, and EBITDA margin. Only 32.74% of the simulations were below the current price, with an average price of $47.61. Both margin and multiple exhibited the highest correlation with the price, having a correlation coefficient of 0.88 and 0.74 respectively. Since the multiple will be driven by the margin, Loblaw's ability to grow or sustain the margin going forward is the key driver of the price and have the greatest impact on the valuation. Now, Aria will take you through some of the risks.
Thank you, Jacob. As seen in the diagram, we have identified high impact, high probability risks facing Loblaw. Lower than anticipated shopper synergies, higher than expected IT costs, and deteriorating margins. Historically, synergies in mergers and acquisitions have been difficult to achieve. We believe achieving the synergies with the Shoppers deal is a key risk facing Loblaw. Our DCF model shows a 15% decrease in share price in a scenario where none of these synergies are realized. Loblaw launched a multi-year program in 2010, focused on improving efficiencies within its supply chain by upgrading IT infrastructure. They have not been able to meet key deadlines to shareholders, as well as been inaccurate with their forecast to shareholders. There's a likely risk that implementation of these upgrades may take longer than anticipated, and therefore lead to higher than expected IT costs for Loblaw moving forward. Loblaw is also expected to have even more intense competition, with e-commerce as well as traditional brick-and-mortar players. Increased competition combined with increased cost of goods sold, as well as lower consumer spending forecasts, will lead to margin deterioration for Loblaw. We did some testing in our model and found that a 1% decrease in our margin assumption changes our value by approximately 18%. Given the risks that we've identified, lower than anticipated synergies with the Shoppers acquisition, higher than expected IT costs, and an IT infrastructure upgrade that's currently incomplete, management faces a challenging 2014. We'd like to reiterate our target price of $45 and a hold rating. We would prefer to accumulate shares at a time where management has overcome some of these issues. Thank you for your attention, and now we'd like to open the floor for any questions.
Why does the stock hold at $45? What's the current price?
It's trading around $41 today.
Right, so go ahead, continue.
When we did the valuation, the current price was $43.75 at the time, and as you know, over the last little bit, the stock has been pretty volatile. So in our valuation methodology, we use a $43.75 current price.
Right, so your return to investors over the next year is about what?
2%.
Right, and what do you think the market's going to do in the next year? What's your expectation for the Canadian equity market?
I guess our expectations wouldn't be any different than the long run average of around 5-6.
Right, so wouldn't you put a sell on, why would I hold it?
The way that the CFA has asked us to do it is if you don't have a 15% holding period return, to put that in the hold bucket. Which is what we've done.
So not to be a real analyst, or to be a real analyst, sorry. There's never a sell, there are only buys or holds. Okay. Full points.
What did you guys do in your on-site visits? Like, did you go in with a scorecard, flyer checks? What did you go and do?
Yeah, actually, Joyce, do you mind bringing that slide up? So what we did is we went to Loblaw as well as some of the competitors, and we did a very similar analysis with all of them. We made similar purchases. We purchased produce, meat, eggs, and we all looked at different metrics such as customer service, cleanliness, and these are the different rankings that Loblaw's achieved as well as what their competitors achieved. We see here that Loblaw did score pretty decent scores with all three different categories in terms of shopping environment, products, as well as services.
So on top of that, did you do any work on what all those competitors have as far as growth rates and how they compare to Loblaw, and also, relative to the multiples? Did you do any work on that at all?
Our on-site analyst visits were more around the shopping experience. However, when we did look at those metrics in our valuation.
Okay, so how did Loblaw compare?
So in our comparable valuation.
In terms of growth rates and, because obviously you're going to be having a target multiple that has to do with the average.
Well, when you take a look at the other key players in the Canadian market, Target's going to be opening up 25 stores over the next number of years. So Costco's going to be opening up 25 stores. Target and Walmart's also going to be planning an expansion. Loblaw's, however, is not planning anything expansive to their own store count. Of course, they do have the acquisition of Shoppers, which will keep them very busy over the next probably 12 to 24 months. So in terms of growth in stores, we see Walmart, Target, and Costco having much more growth in the Canadian grocery store business going forward than Loblaw's does.
What made you go through the governance analysis? Was it anything in particular? Were you concerned about a specific item and hence you want to do a double check?
We weren't concerned, but we did want to evaluate where Loblaw stood relative to its peers. So we used a structure laid out by the OECD, which is the Organization for Economic Cooperation and Development. They have a structure in place wherein they rate companies based on 6 different points, which she's going to pull up right now. And we evaluated the scores based on that. And as you can see, a score over 8 signifies strong corporate governance standards. Loblaw in general does adhere to strong. They just recently hired an independent director called Anthony Fell, who oversees the corporate governance standards. He's an independent director. He oversees the standards and ensures that Loblaw meets the stringent criteria.
Can you go back through your evaluation, your averages of comparables, and just explain briefly why you averaged all 5 different variables? Did I understand that correctly? 4 different variables?
For the comparable valuation?
Correct.
So for the comparable valuation, what we did was we took the North American includes the Canadian subsector. So technically it's 33% American-only competitors, and then it'd be 66% Canadian competitors. We did want to give a little bit of a weight to the American competitors because they are entering the market.
Are their margins and their businesses comparable? Did you feel like you were comparing apples to apples, or?
The margins for a lot of the U.S. competitors are actually better. The one exception would be Costco. Costco operates on a very low gross margin, so their net profit margin was lower. For the other competitors in the space, we actually have a graph that can show you all the margins for the competitors that we did do. The other competitors in the space were a little bit higher. Shoppers now, of course, will increase the margin for Loblaw going forward, assuming the merger gets approved, which we believe will happen.
So your PE multiple stays flat for the next year? Is that, or does it move up a bit, or based on your valuation projection?
In terms of PE multiple, as you know, when there is a merger going forward, there is actually going to be an expanded share count in this case. And in terms of PE specifically, that metric, there is going to be around 275 million in tangible assets. They're going to be written off per year. So we actually, in our valuation for DCF, we used the EBITDA multiple so we could have ignored the effect that's on intangibles for the next 12 years.
Sorry, does it stay the same or does it go up? Or
it goes down slightly.
It goes down slightly. I presume you met with management as well, right? At Loblaw? Did you tell them that you didn't believe their forecast?
When we met with analysts on the call that we had with them, it was 5 questions. That wasn't one of them that we said.
Was there a reason why? So my point being is if you tell management that we don't believe the forecast, they could then come back and really justify for you why we think there's going to be $300 million in synergies and why we think Shoppers is the best thing, blah, blah, blah.
Well, I think if we did ask the management that, I think they might have kind of swayed our judgment, and we wanted to use our own analytical judgment and not management's.
As well, one of the 5 questions which we did ask was what was your best and worst case scenario for synergies? And they didn't elaborate on that. They basically said, you know, it is what we gave out, which was the 1, 2, and 3, $100 million, the 1, 2, 3 years, and we can't give you any specifics on our best and our worst case.
You said they put an independent director on Loblaw. Who was that again?
Anthony Phil.
Right. Did you check the people on the management board for Weston?
For the management board of Loblaw?
On Weston.
George Weston Limited?
Yeah.
We didn't go through George Weston Limited expansion. We did go through Loblaw to assess the different candidates on the management board.
No, I think Tony fell, at least he was on Weston. It's either good or bad depending on your analytical view.
So when you were on the call with management, did you try to get into why they hadn't executed in the past at all, or you didn't go into the track record?
No, when we submitted our 5 questions, it was still very early on in our analysis, and this came up a little bit later on. I believe the call was mid to late this November, and these were a few things we didn't fully explore until later on in our analysis.
Any chance that your analysis is wrong? In other words, that there's these huge synergies and they do the $300 million and, you know, Loblaw turns into a great growth company in the next year? Any chance of that?
Well, we did do a best case, and the best case did give us a price of around $80. So there definitely is a chance that, you know, what synergies are realized, that margins actually expand and up to 1%. The Canadian competition, you know, it's not as ferocious as we think, but in our base case, which is a reasonable estimate, no, we valued it, you know, exactly what management gave us when we believe management gave us, you know, 60 basis points the IT. We believe that could be achieved over the next 2 years, and that was in our base analysis, and that's the price which we got.
Do you know why the IT costs were higher than expected?
Well, so they undertook the largest IT infrastructure upgrade in 2010 in their history, and they estimated an outlay of approximately $70 million in 2012. But currently they've struggled to meet some of their expectations. They want to have a centralized master supply system in 2013, but it's already 2014 and they haven't met those expectations in the end. So we expect the outlay to increase going forward as well.
The timing, as you delay, it just costs more, and IT infrastructure upgrades across the board for companies are always very, very challenging. So I think it's just they're running into the same problems that many other businesses run into.
So is there a forecast for IT expense with Shoppers, or did you know offhand? Or?
Well, they're supposed to operate under separate entities, so we didn't model that cost in directly into our model. However, there is still, you know, we did make the assumption that, you know, Shoppers will continue to have their current IT costs. They're not undergoing a huge. They haven't mentioned that they're going to undergo a huge IT infrastructure upgrade for Shoppers. We would hope that, you know, some of the synergies that they're talking about would later on be achieved through including their IT upgrades.
Thank you.